sure, the provision of liquidity alone can by no means solve the problems of credit risk and credit losses, but it can reduce liquidity premiums, help restore the confidence of investors, and thus promote stability. It can also reduce panic-driven credit problems in cases in which such problems result from price declines during liquidity-driven fire sales of assets. The pricing of the liquidity facilities was an important part of the Federal Reserve strategy. Rates could not be too high to have a positive effect, and to eliminate the stigma of borrowing, the facilities had to be attractive relative to rates available or nominally available in the illiquid dysfunctional markets at the time. At the same time, pricing had to be sufficiently unattractive that borrowers would voluntarily withdraw from these facilities as market conditions normalized. This desired outcome, in fact, did occur. By early 2010, emergency lending had been drastically reduced, along with the demand for such lending. The Federal Reserve's response to the failure or near failure of a number of systemically critical firms reflected the best of bad options, given the absence of a legal framework for winding down such firms in an orderly way in the midst of a crisis, a framework, of course, that we now have. The events of the past few years have forcibly reminded us of the damage that severe financial crises can cause. Going forward, for the Federal Reserve as well as for other central banks, the promotion of financial stability must be on an equal footing with the management of monetary policy as the most critical policy priorities.